Guys, I'm Jenny. Welcome back to my channel. Today, I will be talking about financial literacy. Can you be financially secure even if your earnings are modest? The answer to this question is yes, you can. You may see people with high-paying jobs but still be broke. For example, there are many NBA stars who make millions of dollars in their 20s, and approximately 60% of them are bankrupt soon after retirement according to statistics. The former NBA star Allen Iverson is a unique story here. Why and how they went from a millionaire to being broke? That's because you make more money doesn't make you better at managing it. You could also have a modest paying job but still can build wealth for yourself. The answer is clear. They lack the financial knowledge to manage the large sums of money they are earning. That's why financial literacy is an extremely important skill you should master if you want to be rich. Without further ado, let's get started. So what is financial literacy? Financial literacy is the ability to understand and effectively use various financial skills to make smart financial decisions. To be financially literate is to know how to manage your money. The term financial literacy mainly covers income, spending, budgeting, saving, investing, and overall managing your personal finances. In real business world, they look at financial statements to know how well you are managing your money. You do need to understand the language of money. You do need the ability and the skill to read and understand the balance sheet, the income statement, and the cash flows. Why financial literacy is extremely important? We have never really analyzed how big of a difference an investment in yourself, in developing your financial intelligence can make to your financial present and future. A solid foundation of financial literacy can help to support your life goals, such as savings for a bigger purpose, using debt responsibly, or running a business to achieve the lifestyle you desire, to get the financial freedom. Without financial intelligence, what would happen? As I have mentioned, the former NBA star Allen Iverson, he is infamous for his lavish spending habits and his careless attitude toward anything related to money. He made millions of dollars and he went broke within just a few years after his career ended. You also may see people that win the lottery, $10 million, and they end up back where they started. They lose it all. So we all strive for financial freedom, right? With that being said, we will go through the basics of financial literacies. It all starts with income. Income means money you have coming in. How do you make your money? But don't limit yourself to one source of income, which is your earning income or your 9-to-5 job. You may consider other types of income. For example, income from the profit, interest, dividend payout, rental, royalty, or capital gains if you want to increase the money coming in. Let's take a closer look at each type income. Suppose you are a teacher, you get paid monthly for your 9-to-5 job at school. It's your earning income. You can go to the next level by teaching online or setting up your own teaching business. You get the profit income. This kind of income is accelerating at scale nowadays, and the profit income is unlimited. In the real world, you don't only get paid for effort, but rather when you create value for others. Ask yourself what market needs and wants, and then you provide the target audience with the solution to their problems. Next is interest income, when you lend out your money. Dividend income is the income received from being a shareholder of a company. Normally, you get a dividend payout quarterly. Rental income is the rent you get from your tenants. Capital gains, for example, you invest into real estate for long term. You buy low, sell high after a few years, and you got the capital gains. And royalty income. Royalty income is any sum paid for the right to use of franchise, copyright, patents, trademark, or know-how. Many of these income sources can be considered investing. We will talk more about investing later. Now let's move to expenses. Expenses are money going out. How do you spend the money you have earned? Many people don't know where their money goes. That's why managing that money is just as important as earning it. You should know the differences in fixed, variable, discretionary expenses. The simple rule here is that your expenses should never be higher than your earning income. If you are constantly upgrading your lifestyle, you become golden handcuffed and you get behind instead of moving forward. You need to accept the fact that sometimes you have to sacrifice immediate demands for long-term gain. That comes to a necessity of financial literacy skill that people need to construct their own budget and execute upon that. In terms of budgeting, I think one of the easiest way is the 50-30-20 budget rule, which is 50% of your monthly net income goes towards your needs, 30% for your finances, and 20% for your wants. However, there's no one-size-fits-all budget rule for everyone. You have to be able to change the budget depending on your personality and your perspective in life. Life is bigger than a budget sometimes. The actual budget becomes less important if you get an innate understanding of how to control the cash flow. So the bigger goal becomes making sure that when and how you are hitting your saving and investing goal. And you can get the flexibility with what to do with the rest. For example, you don't have to look at the price tag whenever you make a purchase. I recommend using credit cards instead of using cash. It's a great way to build a credit rating. I have credit cards from different banks. It allows me to track my expenses easier and to get points, to get cash back to build my credit rating. This is going to be beneficial for you in the future if you want to borrow money to start your own business, to get a mortgage, a car loan, or whatever it might be. Check out my video, How to Manage Your Money, by following the 50-30-20 budget rule to get the basic rule of managing your money. Now we will talk about assets versus liabilities. Assets are stuff you own, such as current assets and non-current assets, and liabilities are debts you owe to a person or outside parties. Assets are often arranged in order of liquidity. Liquidity is how quickly you can turn an asset into cash. Current assets are the ones you can convert into cash in a short period of time, typically within a year, such as cash and cash equivalents, accounts receivable, inventory, and short-term investments. And vice versa, it takes time to turn non-current assets into cash, such as long-term investment, tangible assets, and intangible assets. Again, liabilities are debts you owe to a person or a business, from bills you have to pay or accounts payable, taxes payable, to interest payable, etc. So, is your car an asset or a liability? Yes, your car is a depreciating asset because your car loses value the moment you drive off the lot. If you have a car loan, include it as a liability in your net worth calculation. So you have to be very careful before making any big purchases to limit your expenses and liabilities. There is a big difference between buying something with credit that is an asset and consuming something with credit that is liability. The road to building assets starts with saving when you are young and investing strategically. The difference between starting to save at age 25 and starting to save at age 45 or 50 can be a large sums of money. Over the course of 20 to 25 years of compounding, you really exploit the time value of money. But make sure that you are not saving for the sake of saving. You do need to invest or you will lose value due to inflation. Here comes an essential part of financial literacy. It is investing. Invest into real estate, stock market, bonds, whatever it might be. You should be able to diversify your investment in order to make more money and reduce the risk. With diversification, you take comfort when knowing that the value of one portfolio is down, others will likely be up. The return of long-term investment, real estate, stock market, bonds has been promising over time. But in order to get rich, you should be able to pay the price of volatility and high risk. Robert Kiyosaki says that the less liquid, the higher your financial intelligence. You got to be so much smarter to control the cash flow. The beauty of real estate is you learn to use good debt to get rich. You should know the difference between good debt and bad debt. Paying off high interest debt, high rate credit card debt, or bad debt, and leverage good debt. It is called OPM, or other people's money. In reality, many people who live in luxury have little money left over after funding their high consumption lifestyle. So stop acting rich, stop buying stuff you can't afford because you are selling your financial independence. Money is like a game. It has a bunch of rules you have to follow. So the more financially literate you are, the smarter money decisions you will make, and then you can get financial security. That's it for today. Thanks for watching. If you found it useful, like it, share it. I put out new videos every month. See you in the next one. Bye.
Life in a world that keeps changing. Think that it's progress you're making. Copy and paste pretty faces all the time. Pictures so perfect we play through.